Welcome back, everybody. Today's topic, how to recognize market insanity in order to avoid it. This is your host, Dr. Paul Price, for Options Profits. What is market insanity? Well, in my view, it's when prices of stocks are completely unrelated to their underlying value. Shares sometimes can be grossly overpriced. Other times, stocks can go way below any rational pricing. Here's some examples to look at that illustrate this. Lululemon, LULU, last Friday closed at almost $63 a share, and that was 57 times this year's expected earnings. As recently as 2007, the stock topped out that year at $30.30, which was 132 times the actual earnings that year. The average P/E in that year of 2007 was almost 88 times. In 2008, it calmed down a little to about 36 times earnings on average. And at the very bottom of the market in March of 2009, the stock hit a split-adjusted price of $220. So it went from $30.30 down to $220. And at that point, it was irrationally cheap at just 7.1 times that year's earnings. Unbelievable, from 132 times earnings to 7 times. If you don't think that's market insanity, I don't know what would qualify. Here we are back at a pretty high P/E now, more than I would pay for it, but just amazing, from 132 to 7 and back to 57. And while that was happening, the sales grew every year, the cash flow grew every year, the earnings grew every year, and yet the P/E varied tremendously. So it wasn't about the fundamentals of the company, it was all about market psychology. Let's take a look at another one. DuPont Company, August 1st, last Friday, $51.60 a share. Not quite at the high for the year, but pretty high compared to where it's been recently. Back in 2008, in the beginning of the year, it peaked out at $52.50, which was 19.2 times earnings at that time, and a 2.89% dividend. Well, in 2007, the average P/E was 15. In 2008, the average P/E was 15.2. In 2010, the average P/E in that recovery year was a little better than 12. And in 2011 so far, it's about 13.4 times. What happened in March of 2009 when the market hit bottom? DuPont had been so badly beaten up, it went from $52.50 to $16, and it was 7.7 times the earnings, the trailing 12 months earnings, with a 10.25% dividend. So it went from 19.2 times earnings to 7.7 times earnings, and from 2.89% dividend yield to a 10.25% current yield. That is insane that it could change by that much. And amazingly, the earnings fell by about 20 or 25%, but the stock price went from 52 to 16, and you had a chance to buy at a tremendous price. Now, with the stock at 13.4, it maybe looks just slightly undervalued based on its normal history. The typical P/E for DuPont over the last 10 years has been around 14 or 15 times, so it still looks to be just a shade undervalued. So, what have we learned from our little vignette today? Well, what are the takeaways? That even the best stocks experience crazy pricing over the course of market cycles. Absolute value always matters. If you get something cheap enough, you're almost certain to do well. If you pay too much, you're almost certain to do badly on an absolute value basis. Relative value is also a consideration because some stocks are not going to go to 5 or 10 times earnings because they're just not low P/E stocks. And for those type of things, if they're normally a 30 or 20 P/E and you can get them at 15, that might make them good values on a relative basis. You should be using more than one metric to evaluate stocks. You'll notice with Lululemon, because it doesn't pay a dividend, I couldn't talk about changing dividend yields, but with DuPont, I showed you how it went from almost 2.89% to over 10.25% just on the current yield. The further from normal a stock is trading, the more predictable it is for the direction. If it's very, very overpriced, it's likely to get back to normal by going down. If the stock is very, very underpriced, like these two were in March of 2009, they're almost certain to go back up. Take advantage of craziness and do your homework, and you'll do very well when you invest. Thanks for joining me again today. This has been your host, Dr. Paul Price, for Options Profits.